Hi.
Hi, Megan.
How you doing?
Yeah, not bad. Just going to see if I can try and share my screen and see what it looks like.
Yeah, no problem. Now, oh. Mark, can I ask you something very strange? Please, could you leave and then come back in? Only because for some reason it wants you to come in as a presenter and it just thinks you're an attendee now. Don't know. Oh.
You know what? I might need to join you.
No problem.
I'm thinking aloud. Should I go on my mobile phone? It seems like
That that could work. Oh, Jade, you're up as yeah, there we go. And then I think if you come back in, Mark, it will say that you're a presenter. There we go.
Is this better?
Oh, there's
Here we are.
perfect.
Is that better?
Yes, that's clearer. Yeah, absolutely.
Sorry for that.
No, don't worry, not at all. So we're just in the green room now, and then I will allow people to come in as soon as we're ready to go. We'll just start.
Just a bit of logistics. So, Mark, I'll just open up with a welcome message, and then I'll just do a little bit of sort of housekeeping with those in attendance, and then I'll pass straight over to you and control your slides from the back. So, I mean, whenever you want to say move slides, feel free, and I could move the slides forward.
Thank you so much.
Perfect.
We'll just wait until 10, and then we'll start to let people in.
How many people are attending? 35, you mentioned, Jade?
Roughly around 35, yeah.
And then it will also be recorded, so anybody that has missed it or come in late that can catch up.
Can you hear me well, by the way?
Yep, you're coming through clear.
Sorry, I'm late, guys. Are we all good?
Hi, Kat.
Hi, Jade. Megan, I think you're on mute.
Yeah. We'll wait just a couple of minutes and then start to let people in.
Perfect. We're not in a green room. Do we know why? You're on mute again, sorry.
I thought this was the green room.
No, when you're in a green room, it's all yellow.
Oh,
but no. It's okay because we haven't. The fail-safe for that is the fact that you've not allowed anyone to get past the lobby without admitting them, so you're fine. But it means your recording is 20 minutes in. So just when we go to when we go to post this online, we'll just need to cut that first 20 minutes out.
Okay, perfect.
So just a reminder that we'll do that.
Great, no problem. Do you want me to start letting people in? It's 10 o'clock, so we'll just, for the next couple of minutes, we'll just start to admit people. Happy?
Yep.
Great.
Fine with me. You let me know when you want to start, Megan. I'll let you do the introduction, Jade and Megan. Yeah.
Perfect. And I'm sorry, I thought I had actually turned off this sound. So every time someone wants to join, we'll get a notification. But here we go. Morning, everyone. We're just starting to let people in, but if you could just make sure that you're muted, that would be great. Good morning all. So for those who have just joined, if you could keep your yourselves on mute, and we'll just be starting in a couple of minutes. Perfect. So people are still joining, but Jade, I don't know if you want to go ahead and start.
Yeah, let's kick off. So good morning, everyone. Hopefully everyone can hear me and I'm coming through clear enough. Welcome to the Alternative Investment, an Introduction to Private Capital Solutions Masterclass. Glad to have you here today. You might hear a little ping as we go through. It's just attendees joining throughout the actual session itself. Just a little bit of housekeeping. It would be great if you could keep your microphones on mute as we work through, because there's quite a lot of content involved in this masterclass. What we will have is the Q&A session open, so please feel free to fill it with any questions you may have, or any feedback, or opportunities that you may think will be relevant to the actual masterclass itself. There is an actual interactive Q&A session closer to the end of the masterclass, which you can get involved with as we run through. I'd like to just now hand over to our presenter and partner, Mark Ellegard, and he will run through today's presentation with you. Thank you. Over to you, Mark.
Thank you, Jade, and welcome everyone. I'll do a quick introduction of myself. I'm originally from Belgium and Denmark, and I worked for 25 years in the financial sector. I started in New York working with JP Morgan and General Electric, and I moved to London working with Merrill Lynch for many years and a firm called Hoon & Lokey. So my expertise is around advice on first-time access to capital markets, mostly for SMEs. I've done that for 25 years. And we've set up our own boutique now called Blue Square and Associates. So what we do is that we provide advice to SMEs and ventures seeking private capital solutions. So that's in terms of my background. In terms of the agenda for the day, before I go into the bigger picture here, what we're trying to do today is to explain the development of the private capital markets, which could be quite interesting for many ventures, not just for their funding need today, but also for the eventual future funding. I can see many ventures coming to me, often thinking of raising capital. Sometimes the answer is this is too early stage for us, but you still need to think about how you're going to be funding yourself in 1 or 2 years, and prepare yourself in terms of your funding needs, your future funding needs, and avoid some mistakes today that will basically make your future funding solutions more difficult. So that's what we're going to try to achieve today. There's going to be 2 parts to the discussion today. The first one is the bigger picture, just explain the private capital markets, and the second one is how does it apply to yourself. So in terms of the bigger picture, I'm going to say things that probably many of you already know, but let's state the obvious. You probably know back in 2009, 10, 11, there was a big financial crisis with banks under severe pressure. And what happened is that regulators across the globe put much more regulations around different type of exposures they had. That was true for structured credit. It was true for SMEs, for ventures. So what happened throughout the last 15 years is that banks have to charge much more, they have to post much more capital against the exposure to SMEs or ventures, which makes it very difficult for them to lend or provide solutions to those SMEs and ventures. What has happened as well is that there's been an explosion, a huge increase of private capital solution. Some people call it alternative funding solution. Alternative meaning alternative to banking solutions. Over the last 15 years, you've seen a huge increase in, private equity, in private debt, in all form of hybrid type of capital, and obviously in terms of venture capital as well. So one of the reasons for that is that many of we call it the real money providers. So let me define what are real money providers first. Real money providers are, people managing money for savers, for insurance, for sovereign wealth funds, for large family offices. This is what we call real money. It means that it's money that's, directly managed for the owners of that capital. So private equity, for example, is not real money. It's money that's been raised from pension fund, from insurance company, from family offices. And the same applies to venture capital, by the way. Venture capital, unless, it could be a single family office, but it tends to be money that's managed on behalf of other real money providers. So what has happened is that all those large players, the insurance companies and others, have decided to go and allocate capital in the private sector. When I say private sector, it's as opposed to public markets. Public markets, just to go back to another definition, public markets are markets where you have, a form of security being traded on a centralized exchange. So it can be shares, it can be bonds, and so on. Private market are not traded on a central exchange. This said, just to be clear, some private debt is being traded between different private debt funds, and that happens, but it's on a private basis. So the reason we're going through this first section again is that what we are seeing right now is that there are more and more private capital providers that are providing highly bespoke solutions to SMEs in general terms. So everyone knows the venture capital fund on this call, probably. People might be less aware of other forms of private capital solutions. Private capital solution can be not just private equity, i.e. someone buying your business. It can be someone buying into a minority equity stake. It could be a fund providing money into a form of a preferred equity instrument. It could be a private debt instrument. Private debt means many different things. It could be a convertible debt instrument, or it could be an asset-backed instrument. When I say asset-backed, it means backed by either a tangible or intangible asset. And it can be cash flow-based lending. So I think that sometimes I see ventures coming to me and they're not aware that there are sometimes alternative funding solutions which are open to them now or in the future, which might be more interesting than dealing directly with a venture capital fund, often for a very dilutive type of solution. So let's just go again back to the basics here in terms of those alternative products. And you see that in the section B here. What we look at when we look at a venture on SME is what's the nature of the business? What type of clients you have? How resilient are those type of cash flows and contracts? What's your asset base, tangible or intangible? So coming back to those definitions here, for example, an asset-backed debt instrument, as the word says, it's a debt which will be collateralized by an asset or a pool of assets. Those assets can be anything from a tangible asset to an IP, a valuable IP you might have. Or it could be on if it's a cash flow-based lending, it can be a form of loan, which will be secured against existing or future contracted cash flows. Let's say that someone has a major client those future cash flows, contracted cash flow from this client, have a value. If you discount those future contracted cash flows, you can eventually raise a loan against those future contracts or existing contracts. So what we've seen in the market is that there are more and more capital providers going to that space, which is, you probably heard, inventory finance, factoring, asset-backed financing, cash flow-based lending. Also, what we've seen is that there's been, because of the bigger picture issues, is that the access to public markets has been challenging last 2 years. The pre-IPO market, as we call it, in the US is more sophisticated than in Europe. But still, in Europe, you have many capital providers that have filled that gap in terms of having ventures which slowly get ready for an IPO, and they would provide what we call pure pre-IPO capital. So more and more firms are delaying their IPOs, but they're accessing the private capital market. And that private capital market can be, again, I'm repeating myself, can be accessing different debt instruments or equity instruments. Let me go to a basic component of size here. A lot of those capital providers, when we talk about loans or minority equity or preferred equity, have a size threshold, which is often too large for many ventures. It tends to be minimum 5, 10, 15 million sterling in order for them to say, we have an interest for that later stage capital allocation. So the minimum ticket size is an issue for those alternative capital provider. But what I would say to many people is that often you need to think about that next fundraise, which is the 10 million plus, which might happen in a year, 2 years. You might want to think about it today, because there's a way to prepare yourself and a way to avoid mistakes that might affect that access to that capital in the future. So that's page 2. Jade, if you could go to page 3, which might be a little bit more relevant to our discussion today. So what we see when we talk with SMEs and late stage ventures is that often the CFO comes with, how great is the business? Here's a valuation, here's a pre-money valuation, and that's the type of dilution we'll accept. And that's all great. But sometimes it's, in terms of concept, it's not only about how great is your business. It's sometimes about what is your resilience in your business. And the reason I use the word resilience is that sometimes people, even for quite early stage businesses, people don't realize that if they start to have some form of, strong client base, even a concentrated client base, it does open potentially the route to less dilutive funding solution. So you cannot think only in terms of equity upside. Once your business start to mature, you have to think about downside risk. And the reason you have to think of downside risk, I'm repeating myself, is that provides you access to people providing capital in a very different form. And that's mostly credit products. So there's been a huge growth in the private credit market, as you know. There are funds like Apollo providing funding solutions which are ranging from inventory finance all the way to private debt or equity growth type of solution. And so that's a space they want to be in. And the only way, again, to access this is by institutionalizing a little bit your fundraising. And when I say institutionalizing, it cannot just be a VC approach to the world or pure growth. It needs to show, the resilience in terms of your cash flows, but also in terms of your operations. And so I've set a list of questions here in the point C here of the agenda here. But people underestimate sometimes that businesses are each very different. Some businesses are very, very much IP driven. Some businesses are very much, we're going to lock in customers quite quickly. We're going to lock in eventually some longer term contracts with one client, two clients, or sometimes thousands of clients. And depending on the profile of your business, you might be able to find a solution which is very different. Let's say you have one client, the solution might be very different compared to if you were to have 1,000 clients, which are retail type of clients, where you have a diversification, uncorrelated exposure, where you can find another form of capital solution against that client base. So it's always good to go back to basics, translating your business, not just in terms of or great is your business in terms of the vision, but what's the basic, how would you describe your business in a very simple way in terms of your client base, the operational risk, your ability to withstand, some downside risk, all those things. If you outline that, that will translate in a different form of financing solution. So in terms of, if you're a CFO, CEO, what we typically like to see is that in order to assess the optimal financing solution, an optimal financing solution, not just today, i.e. you're going to raise 10 million in preferred equity or another form of instrument, but also if you believe in your business plan, you might have a solution in a year or 2 years, which might be the following. So let's say it's a credit solution in 12 months, which is highly structured. That will affect how you're going to be funding yourself today. So people say, oh, I'm going to need to access a very dilutive venture capital solution. I say, yeah, okay, but that's fine. But are you going to need to re-access the venture capital market in 12 months, 24 months, 36 months? And if the answer is no, it might be completely different in terms of the way you look at your current funding solution. So again, I think that when people show a business plan, they need to show also, obviously, the cash flow projection, but at what juncture in year 1, year 2, year 3, they believe their business is de-risked. Not just de-risked in terms of quantum of revenue or quantum of income, but in terms of some form of downside protection or visibility in those cash flows. We are not only in the business of how great is your business again, is how visible or predictable your business might become in 6 months, 12 months, or 18 months. So that's the first thing we like to see. The second thing we like to see is typically the use of proceeds, obviously. And the use of proceeds are received differently depending on the form of capital. Some form of proceeds are purely salaries for very good reason. Sometimes they are more invested into assets. They can be invested in IP. They can be invested in CapEx. But depending on the use of the proceeds, as of now, in the future, obviously that will affect the perception of those investors. And some investors are much more flexible in terms of salaries or IP investment versus others say, sorry, we're not into investing to IP, we're into the business of investing in predictable future cash flows, and here's 10 million, we can do that. So that's the second component in terms of preparing yourself when you go and try to access those different private capital solutions beyond just the venture capital route or the family and friends route. There's also another element that I think is important, is that what we've seen quite often is that there needs to be the capital providers are not pure venture capital providers. They're not in the business of, let me put in simple word, of completely underwriting your business as a venture capital fund would. So if you're a private equity provider providing a minority equity or preferred equity, obviously you're going to do a deep dive, maybe not as extensive as a venture capital, but you'll do a deep dive in the business. You will really try to understand it. But if you're more of a bespoke credit provider, you will ask one question: am I protected? But the second thing that all those investors will ask is, do we have an alignment? Can we trust that if this doesn't work, it's going to be as painful for the management team and the existing equity shareholders as it is for ourselves? The point is that they don't like to provide free optionality. And for obvious reasons, the cost of capital is much cheaper than venture capital. So the third point that we like to verbalize, understand, is how well is the management team and the existing shareholders aligned with the new capital provider. And then, the other thing I want to just say, I've been talking about equity and preferred equity and credit and all. In order to simplify all that, the real question we need to ask ourselves is, what type of return you're willing to give to that investor? So there's a quantum, which is the cost of capital, but that quantum should be divided in two simple components. One is that's something I can secure in terms of return to the investor because I'm comfortable with my business plan. The other one is a little bit more difficult to assess. It's almost like a form of upside potential, which often have a form of optionality. It's to say, within those type of cash flow projection, I'm quite secured on those. I believe this is quite predictable, but above that level, I'm going to have an amount of cash flows that I believe are more speculative. If that's the case, it's not a problem. You still need to divide the return you're going to provide to your investor between something which is eventually a form of secure type of return, an interest, or could be a form of profit share. But the upside can be structured in very different ways. So what I'm trying to say is that among those different capital providers, there are, I call it the middle range ones, the ones which are not looking for a pure equity type of solution, and the one which are not looking for a pure credit solution. They're happy to look at the blend between an equity solution and a credit solution. They would say, okay, we might provide you a loan with a warrant, or we might provide you two different instruments. But I think that that's often the case when we deal with late stage ventures. And the reason this is very interesting is that in most discussion days, what we call an information gap, there's an information asymmetry between the business and the investor. In simple words, again, the investor doesn't believe in your valuation. And the business say, that's my valuation. I believe in it. So the way to bridge that gap is to say to the party, okay, you strongly believe in your valuation based on those cash flows. Okay, if you believe that, then you should be willing to provide a form of preferred treatment eventually to that capital provider. And if you underperform that business plan, the equity provider will be treated before the existing shareholder in terms of return. So often those instruments can be a way to bridge that belief in different valuation levels. But there's always downside risk. I'm sure everyone will ask me that question. Mark, I'm going to issue a credit instrument, a preferred equity instrument. What happens if I underperform? If you underperform, it can be painful because obviously this capital is sitting above the management's equity and the existing shareholders' equity. So again, that's coming back to my first question. How strongly do you believe in your cash flows? How strongly you believe in the resilience of your business? And what business plan are you willing to underwrite? And sometimes it's better to be conservative. Being over bullish is not always a solution. Actually, to be bearish sometimes attracts investors. Say, okay, I like the upside. I give a probability of 70% on that upside, but I like the fact that they are so open about the risk in their business. So what we often do is that we come with the vision of the business and the huge potential of the business. But what we do as well is to be slightly obsessive about the downside risk of the business. And by doing that, we build a trust level with the investor. The investor say, okay, now I understand my risk. I can maybe, mitigate my downside risk across those risks, working closely with the business. So, in a nutshell, what we're trying to do here is to work on a wider scope of solution in a philosophy which is slightly different from many people which are dealing with growth, is to understand growth, but to understand downside. And that basically translates in different type of funding solution in the future and sometimes in the present. Jade, if you could go to page maybe 5, just to finalize exactly. I mean, this is an oversimplistic page. People talk a lot about those different stages. And I understand why the venture capital community has those milestones in terms of the type of fundraisings. But to be honest, I'm coming a bit from an old school, which is every business is different. So again, what we're looking at is, beyond Series B or C, or we're trying to understand where does this business fits on a pure capital standpoint. We're not saying, oh, we've raised 5, then we raised 10, and now we're raising 20 in Series B, and then we're going to say, okay, I got that. So it's A, B, C, D. But we're not into the A, B, C, D. Well, to be honest, we're in the business to say, what's the risk return of your business, and is there scope for you to access a certain type of capital which you might not have thought about? So that's where we come in, is to say, down the road, you might be one day, not dependent on family and friends or early stage venture capital funds. You might be dependent on venture capital funds for all your life, fine. But what we're trying to say is that you might want to think about alternative routes, which are more like later stage type of solution, or more like highly bespoke credit solution, or what I call hybrid solution between credit and equity. So what we do first, again, is to understand your business, not just in terms of those milestones, but also in which bucket do you fall in terms of potential capital solution. And when I say bucket, it's all those different investor types we've been thinking of. And so, what we do when we work with our clients is, the first thing we do is to understand your business in a very simple way. And then obviously we share notes in a very concrete way in terms of the potential terms, the potential capital structure solutions. And then people say, we don't believe you. And then what happens typically, if we like the business and we believe it's a strong management team and a strong business, what we do is we run basically a discrete process, as we call it. We're not in the business of, running wide processes of fundraising. We want to be quite focused on targeting those bespoke capital providers with terms we already know might be attractive to those capital providers. And if we cannot do that, we just don't take those type of assignments. So we're trying to be very specific about the type of funding needs you have that will fall within a certain type of investors. And that helps us direct the process in a clever way. So I know all this is quite generic. I'm happy to go more into details. That's not a problem. I was saying to Jade, I almost rather make it slightly more interactive. So, we can have a Q&A now. If one or two people, if you happen to have a business which is slightly more mature, want to ask questions, happy to have a complete open agenda. So that's pretty much it, Jade. So happy for Q&As and discuss maybe something into more details.
Perfect. Thank you, Stephen. Sorry, thank you, Mark. We've got a question from Stephen in the Q&A. It was from about 20 minutes ago, but it says, do these private capital providers, in essence, have piles of cash waiting to be invested rather than creating money when they lend, as banks do?
That's an excellent question. So let me put in simple words. Banks have been in the business. Let's speak about the revenue model of the funds, right? There's no hidden agenda here. Banks have been made money by charging an interest income and making a net interest income in terms of the lending going forward. Funds are also in the money business. The people managing the funds want to make money. And the way they make money, typically, not always, but typically, is that they have a fund, which can be a credit fund, a private equity fund. And what they do is that they have investors into those funds. So let me take you an example. If you are a fund like ARES, ARES, you have hundreds of billions under management with different funds, with different strategies. Each fund tends to have a fund structure. When I say a fund structure, is that there's a general partner. The general partner is managing the money. That's ARES. And the limited partners are the investors into the fund. And those invest into the funds are big pension funds, insurance company, all the real money provider I mentioned. If you are the manager of a fund, you charge an annual asset management fee. It can range from 50 basis points all the way to 2%, depending on the type of capital. And you earn a carry. A carry is basically a percentage above a certain return that you can retain as a manager. So coming back to the question, yes, they are in the business of making money. I'm saying they, meaning the people managing the money. But I would say it's fair to say that there's more and more pressure on fees from those managers, because the real money providers more and more are saying, guys, you cannot charge those type of fee going forward. And some of them, just for your information, are investing directly, more and more avoiding those funds. So you have Canadian pension funds like CPP and others investing directly without going through those fund structures. So this is LNG is a big insurance company in this country. They're investing more and more directly in different asset classes. So, but coming back to the question, yes, there is a revenue model for those fund managers. Sorry for the long answer.
Perfect. So we don't have any other questions in the Q&A as of yet, but if anybody wants to start adding them either in the chat function or the Q&A, I'll be monitoring both. And then, Mark, did you say if there is anybody that would like to ask you kind of questions, they can turn on their microphone and join?
Right.
Perfect. And sorry, I was going to say, just to let you know, some people, there is somebody has put their hand up. If you're happy for Adnan, if you want to unmute and chat.
Hi, Mark. Thank you. My name is Adnan, and I'm the innovation manager for Atkins Realis. And my question is more around how large corporates such as Atkins Realis, and we are exploring this option of where we can onboard startups and SMEs by either investing in their equity, IP. So is there a route for large corporates, consultancies to to start supporting the wider innovation ecosystem? So that's my question.
So your question is, you are a principal, right? So you're looking to deploy capital in the space, or in this space, and your question is about how can you be more present in that space and underwrite the underlying opportunities in a more clever way? Is that the question?
Exactly. That's
Okay.
my question. Yeah.
So it's a question as a principle for everyone. So, Adnan is an investor, so it's coming from the buy side. I would say that, when you look at the competitive landscape for you in terms of the landscape of the type of capital that's been provided, I think there's no doubt that, there's a lot of venture capital, which has been, to be honest, much more conservative since probably more than a year. But beyond the cycles of the venture capital market, I think there's something to be done within the early stage businesses more cleverly in terms of capital provided. And you've seen some funds doing it. So, I see some small funds being set up that says, you know what, we're going to provide a more bespoke, sometimes credit solution of 1, 2, 3 million for people that we believe deserve that solution as opposed to a venture capital solution. So, I've done, for example, someone I know, I used to work with him, setting up a fund that's more like a more asset-backed type of solution for early stage or late stage ventures, with a return which is lower than a venture capital fund, but obviously much higher than what the bank would charge like 10, 20 years ago. So I think and the way to market that is quite interesting, because a lot of those ventures would basically, be very responsive to that type of solutions. But you need to be able to really work hard in terms of, when you write a 1 or 3 million sterling check, it's the same amount of work as a 10, 20 million. So in terms of underwriting the deal and putting the time and effort, it's actually even more work. So you need to have a solid team, hands-on, that's willing to put the time and effort for small investment. But I would say in terms of risk return, there's a huge capital gap in that space for smaller ticket sizes, for more bespoke solutions, which are not necessarily the pure venture capital solution. I think that's the way to basically differentiate yourself in terms of your product offering.
Great, thank you. I think, Charles, you have your hand up.
Hi, yes, good morning. I hope you can hear me okay. My name is Charles Hall. I'm from Neva Group Limited. I'm sorry, I joined this group a little bit late, so if you've already answered this, I apologise. So I have been in the sort of game for the last sort of 5 years or so, looking to raise funds, and I've kissed a lot of frogs, and I'm delighted to say that we have a lead investor. What I'm trying to gain is, we've answered a lot of questions. We have a lot of good answers to a lot of questions. I'm just interested in your perspective of how is risk appraised from the investor's side. And what I mean is if you look through one looking glass, it's the best thing that's could ever happen. And then you're looking for another looking glass and it's a completely uninvestable project. So how do investors, VCs, private investors, how do they make their decisions? And then also, how do you make sure you're trying to talk to the right person who's making the decision? I know that's a very grand question, but hopefully you might be able to help me with who we're talking to and how this risk is appraised. Hopefully that's a okay question. You understand what I'm trying to get at.
Absolutely, thank you. So for everyone, the question is more about, how is the risk and the list of risks for a business being perceived and addressed and assessed by investors. The first thing I would say, Charles, is that it depends on the type of investor. So if you are, I'm going to state an obvious point, if you are a real early stage VC fund looking to find the next IP that's going to be the next thing, the question are going to be very much around IP rights. It's going to be quite legalistic. It's going to speak about barriers to entry, first mover advantage, all those common things. So the risk perception there is very different than if you go and see someone that says, oh, I'm going to basically provide you a bespoke credit solution against one contract. And here's 5 million. So let's say that you have a major contract, you have an IP. The question around risk will be, obviously, they're going to cover some of the point of the IP, but more importantly, they're going to cover all the points around the contracts. How easy is to get out of that contract? How resilient is that contract? Under which jurisdiction is it? Who is the counterparty? Is there an operating performance risk under the contract? So what I'm trying to say is that that's exactly the point of almost the presentation today. The risk perception changes depending on the type of investor. So it's always important to understand your audience. Who is your audience? Number one, are you going to the right investor? But two, if you go to the right investor, what's their perception of risk? And how do you need to address those risks in front of that, audience? So my question for you, Charles, is who are you talking to? Are you talking like...
Sure.
Yeah, go ahead, Charles.
No. All I was going to say, sort of try and reflect back to you a little, is it feels like I need to have a risk meeting or understand their appraisal to risk before I do a pitch.
Yes.
Because it feels like I need to sort of set the groundwork rather than going straight in thinking that they're really into their sustainability. That's what their fund is all set up for, and just go straight in and get all excited. But it sounds actually I need to do my due diligence on them first, and then see, okay, we're not going to fit into your criteria. Let's just part as friends. That's what it kind of feels like I need to start conducting.
I agree.
Is that something?
Yeah. I would add, Charles, one thing. Within each of the investor type, they tend to be a repetition of the type of approaches they have. What I'm trying to say is that people are quite similar within one specific investment philosophy. So if you go to early stage or later stage sustainable type of capital provider, there tends to be similar type of criteria. But I would say that within the sustainable capital provider, I just want to state the obvious again, there are many different types of sustainable capital providers. Some of them are completely sustainable driven, but I'll be honest with you, I've met many which are saying they're sustainable investors, but actually they're completely commercial, i.e. they want a return of X, Y. So there's many different types of sustainable capital provider. So understanding the DNA of the investor before talking to me is quite important. So I would strongly recommend to try to understand what they do. And that's not too complicated to do, to be honest. And sometimes the best is to actually ask those questions before pitching, if you have the luxury to do so. But, you should be in a situation where you should understand the funds, their objective, which deals they've done in the past, which deals they have declined and why. I mean, there's sometimes a way to get those answers for this investor.
Yes. Brilliant. Well, thank you very much.
You're welcome.
Wonderful. We have another question here from Nigel, and he says, I run an early stage.
Sorry, I lost you.
Yeah, me too. I lost there. Do you want me to read it out? Is my question.
Please.
Oh.
Please.
Yeah, sorry, Megan, we lost everything there, so.
I think, Nigel, if
Perfect.
you could Good question.
Nigel, you go ahead.
Yeah, I was just saying, I run an early stage tech startup. We're post pre-seed. We've done a successful SCIS round, and I was smiling at this chart because we've got our own kind of version of where do we think the fundraising plan takes us over the next 4 steps, as it were. It sometimes seems a bit grandiose to be plotting that far out, but I'm very conscious that you need to know where you think you're going along the journey, even if the plans change. But I was interested if there was anything that early stage companies should try and avoid doing early. You know, this is what I call landmines. What I don't want to do with our financing is do something now that actually in a couple of stages time I look at and go, oh God, I wish we hadn't done that because it's blocked off some opportunities. So I didn't know if there were things that you sometimes look at in a late stage funding plan and just won't touch because they've done something early on that closes off opportunities or options.
This happens very often. I'll be honest with you. I think it's the mindset which is wrong. You know, I'm not an early stage entrepreneur, so you know, I don't want to give lessons to people. I can just be completely pragmatic about saying what you should avoid in terms of accessing the capital that I know quite well. I would say that's one. I think it's almost philosophical sometimes. There's a lot of people, most of the people, for very good reason, because that's what an entrepreneur does. They think of, oh, my business is great. How can I grow it? How can I implement my plan? And I believe in it, and I'm going to make it happen. That's all very good. But I do see also people that have been quite successful. They've been sometimes very obsessive about the underlying risks in the business. So basically the trouble, if you're a great troubleshooter, right? You say, I can see there's a problem. I'm going to fix the problem. That's what I'm going to do today and for the next 2 months. I know there's growth here, but I need to fix problems. There's some people which are great at doing that. And they're great at knowing what's going to be almost the next problem coming sometimes. So what I'm trying to say is that sometimes I ask the question, what's your perceived risk today and in 12 months? And many people don't have the time or sometimes the mindset to think about that. And I would say that I'm coming back to basic. I think there's some businesses that should be able to define their businesses in much simpler words, not just in terms of, you know, the type of business you have, but just in terms of what's the underlying risks of your business. I don't hear that quite often from the more early stage businesses. What's my risks? Because depending on those risks, if you can mitigate those risks in 6-12 months, you're going to have access to a form of capital which is much more interesting. So, and there are ways to mitigate those risks. Let me show you an example. There's some people say, oh, I don't want to take this contract with this client because you know what? My margins are too low. I'm like, okay, and my valuation is going to go down. I say, okay, but that's not the point. The point is that if you can secure a form of cash flow through a contract, which might not be the most profitable, you might be able to access a different form of capital, which might be much more interesting. So sometimes you being over commercial is the wrong thing to do. It's about saying, if I were less greedy today or less obsessive with valuation, but if I would think of sometimes slightly de-risking my business model, and that's true also for centralized cost and, you know, operating leverage and so on. I said, do you really need to spend everything today? Could you not just say you start with a middle step that's going to give you an access to a form of capital which is cheaper? Do you need 200 people right now? Really? You know, so sorry for the abstract answer, but I think it's really about looking at alternatives to de-risk your business plan sometimes at the early stage. I think that's the message here.
I think it's interesting what you said about taking commercial contracts, because we're doing something which is a totally new product class that hasn't existed before. We're trying to introduce it into industries that have never used it and are still kind of not very knowledgeable about it. And I have been saying to the team, I'm not that worried right now about getting the pricing right. because generally I don't know what the market price will settle at. I'm much more interested in getting kind of the deal flow, and until we get a number of the same kind of deals, we won't be able to do any kind of activity-based costing to see whether we're actually making a margin on it. So some of those early deals are actually more totemic than they are important in terms of kind of total profitability.
Mm-hmm. Absolutely. So no, but that's you're exactly right. You need to be able to outline, a little bit what's your aspiration in 12, 24 months, and avoid making big mistakes. People going with a wrong investor, sometimes too early stage, happens quite often. But often you need the money, you take it, right? I mean, I'm not saying, but sometimes you might have alternatives. The key point is to open yourself alternatives and options. You have, the more options you have, the more clever you are. But you need time for that. You need someone dedicated to the team to look at that, right? So, yeah.
And I think that the options and the questions get more complicated to the right-hand side of this chart. Down at the pre-seed stage, because of the tax investments like SEIS and EIS, there's kind of a set of guardrails in terms of where you're going to raise funds, which are pretty tight.
Yeah.
And so there's not much thinking around a pre-seed raise. It's about going and finding the people. But as you go down each of these steps on your chart, the options and variations of finance models seem to get more complicated and then more varied.
Yeah, absolutely. I mean, on the pre-seed side, within the SEIS structure, obviously it's more rigid. I mean, again, I fully empathize with all the merits of EIS, SEIS structures in the UK. I mean, they're great. I fully understand that. But even then, there are other options sometimes which might be quite interesting with all the tax advantage for the investor. So that's another discussion. Yeah.
Yeah. Thank you.
You're welcome.
Thank you very much. We have a question in the Q&A chat. I'll give Mo an opportunity if he wants to unmute and ask the question. If not, I could read through it.
Yeah, thanks. It's probably like a segue from the previous conversation. So oftentimes in pre-seed and seed, we find ourselves in a position where we need to be able to show or demonstrate an MVP or something in order to get interest and buy-in from customers, so that we can go and talk to VCs. And on the other hand, for that to happen, we need to have money. And a lot of VCs sort of claim that they're pre-seed or seed when in fact they want to see concrete buy-in. So it's a bit of a conundrum, really. I'm just interested in your thoughts on that, Mark. Really, that's it.
It's the next question. I mean, to be honest, it's something which happens in other investor space. To put in simple words, if you want to have a huge return and you want to have a quite strong form of, proof of concept or downside protection, there's something that doesn't work in my view. Let me put in simple. If you're a VC fund and you're looking to do like, a 20x or whatever on your investment, and I know it's a diversification play for them. They say, oh, we're going to have one successful out of whatever it is. That's one thing. But in reality, there's many venture capital funds that says, we want to have something which is much more proven, that what is our fund really, compared to the philosophy of our fund, we want something which is much more proven and de-risked to a certain extent. They don't want to take the risk of having 1 out of 20 or 30 working out extremely well and basically compensating for all the other losses. So I do come across venture capital funds that I have to say are extremely dilutive, extremely expensive. And they're basically saying, yeah, but we need 1, 2, 3, 4, 5. There's a price for everything in life, including risk return. So that's where, coming back to the first question about Nan, I think there's an arbitrage here. I think if you have some form of downside protection, your cost of capital should go down. Simple as that. And so that's why you have a vacuum. And I think some of the private capital providers are slowly going to go into that space. It depends a bit of the cycle. The cycle is a bit difficult now, but I think there's going to be other form of capital. And that's also linked to all what's happening with reporting, right? You know, more and more you're going to have technology around reporting systems and so on that's going to validate and give comfort to those capital providers, which are not pure VC capital providers. But that's something that will happen. So I agree with you. You know, you cannot have the cake and not eat it, right? So, but thank you for the question. I hope I've answered it more or less correctly.
Thank you.
Perfect. We have two more questions. So I don't know if you could maybe really quickly just give a 1-minute answer to them, if that's all right. So the first one is from Nuri. Given your perspective on private capital markets, what key metrics or economic indicators do you watch to determine whether the market is becoming more or less favourable for alternative financing? And then the second part of that is, are there any early warning signs that might suggest companies should accelerate or delay their fundraising plans?
Question one, it depends on the capital flow being invested in private capital and at what cost, at what price. And when I say price compared to, you know, treasuries, government bonds, inflation level, right? Obviously, you need to be reflective of the cycle. So capital flows and the pricing of that private capital, that's the way you look at the metrics of how warm the sector is. I can just tell you that there's a huge amount of capital going that space. The venture capital funds are a little bit more difficult these days, but all the alternative credit space is very, very active these days across sectors. The second question was around...
Yeah, are there any early warning signs that might suggest companies should accelerate or delay their fundraising plans?
I would say if you start to raise capital that disalign management, that's never good. When management doesn't believe anymore in the business because they've got the wrong funding, there's something that says this is we working for someone else. There's free optionality for the capital. That doesn't work. So it's almost psychological. Do you feel comfortable that with your hard work, you're going to be controlling somewhat your destiny and your work? So sorry for the short answer, but
perfect. And the final question. Oh, sorry.
We cannot hear you, Megan.
Sorry. Okay, no worries. Hopefully you can hear me now. Just one final question. How do the private capital funds finance their due diligence work on potential clients? And do potential clients have to pay a fee upfront for all the work you have to put in before you say yes or no?
No, typically, not always. You provide exclusivity to one capital provider, and they will basically be funding their due diligence work, legal, technical, and so on. But you need to provide exclusivity to that capital provider based on a term sheet. I can discuss it if you want to. No problem.
Amazing. Thank you, Mark, for the presentation today. It's very, very thought-provoking, and I love the interactive session as well. I believe that our attendees had a lot of good feedback and resources. We have. Yep. Is there a way that we could get in touch? Are you happy for your details to be circulated after the meeting?
Sure.
Perfect. So thank you.
Yeah, no problem.
Thank you very much. Thank you for everyone for attending. You will be getting a copy of today's slides and also Mark's details if you have any more thought-provoking questions. Please do keep a lookout for our feedback form off the back of this session and also for the upcoming masterclasses as well. Once again, thank you for attending. Thank you, Mark, and have a great day.
Thank you, Jade.
Thank you.
Thank you, everyone. Bye-bye.
Bye.